So today, yeah, right, the 21st. Oh, where am I? Yeah, the 21st. Sorry, for a minute, I lost my way there. I thought I'd split this class because we are tracking ahead. That I'd split it between more of chapter 15 and maybe just a little bit of going over, right, the stuff that you need to know for the test for chapter 13 and 14. Just a reminder that next week, Tuesday, your chapter 14 homework is due. You should be treating this, this time, especially over the weekend or whatever, if you aren't working, hopefully you're not, or whenever you're doing the homework, as also an opportunity to be studying the concepts. And on Tuesday, the test and the quiz will open at 9 a.m. and they'll close on November the 2nd at 6 p.m. All right, so we're coming into. I'm not going to do it. I'm not going to do it on Tuesday. I thought I'd do some of it today. I don't know. Let me think.
I'm just not sure if to take the test or wait till we do the
I was
review and
gonna,
then.
no, I'm gonna do the review today because some people may want to take the test on Tuesday already, although I don't know how you would take the test, between 9 and 10:30 when our class starts, but it doesn't really matter to me. I'll do some of the review today because some people may want to study over the weekend. And if there's more questions on Tuesday, I can go over a few more concepts, but I think the review is better placed today because then if people are studying and planning to take the test on Tuesday already, you don't have to wait for me, for the review in order to study. Okay, so I'll do some review today. I'm not gonna push, I don't have to push too hard. I think I'll stop whatever we're doing with chapter 15 before the break, and after the break the break is around whatever 11:35 or so, and after the break we'll carry on with the review. And please just know that when I'm reviewing, I'm not going to be reteaching the material. That's not the purpose of the review. What I'll do is just highlight all the different topics that we had in a chapter, and then I actually for chapter 13 and chapter 14, I actually have an example that I'll work through with you, and we can reinforce the concepts as I work through the example. I don't think it's of value to you guys for me to just sit and lecture the topics again. We actually need to see if you're able to do or to understand the work. All right, so chapter 15 we started last time, and I gave you a whole big discussion on what a bond is, and then we spoke about issuing a bond at face value. So again, a bond is an interest-bearing note payable. There's interest on it. A company is selling or issuing the bond to investors. Investors could be individuals or other organizations. The bond will have a dollar amount attached to it, which we call face value. And remember, in your textbook, I showed you this. Let me see, I've probably gone too far. Yeah, this picture, this is an example of a bond. That's the face value, the dollar amount, $5,000. There's the contractual interest rate. This is how much interest is being paid annually. And then the question would tell you whether the cash amount is paid out semi-annually or what, right? So this is the annual interest rate, but the cash may be paid every 6 months. And then 2023 is the due date. So that's the, what we call the maturity date, this May 1st, 2023. The issuer is the company that's actually borrowing the money. And so those are the key features, right, of a bond. And we also use those key features in our journal entry work. So looking at the possibilities for bonds, I'll just mention that bonds can be issued at face value, which is also referred to as PAR, P-A-R, value. They can also be issued at a discount, which means that the cash that the company is receiving is less than the amount that they will have to pay back in the future. And they can also be issued at a premium, which means that the cash that the company is receiving for the bond is more than what they will be paying back in the future. And the thing that determines whether the bond is issued at face value or whether it's issued at a discount or premium is the interest rate of that bond in relation to the interest rate in the rest of the market. And so just to review this again, although we've gone over it, I'll read it and you know, just make sure that everybody is on hopefully the same wavelength here. But on January the 1st, 2013, Candlestick Corporation issues $100,000. That's the face or par value, 5-year. That's the term, TERM, the term of the bond. So after 5 years, we'd have to pay the money back. 10% is the annual interest rate, also known as the contractual interest rate. Bonds at 100. 100 is just meaning that it's 100% of face value. If it was discounted, it might say something like 95 or 98. If it's a premium, it would be above 100, so 101, 102, so on. So at 100 just means at par or face value, 100%. The bond pays interest semi-annually. So there's this every 6 months. So this 10% is really 5%, right? Every 6 months on January the 1st and July the 1st. And the last time I told you that obviously on January the 1st, 2013, when we first issue the bonds, there won't be any interest attached to that because interest is going to accrue over time. So the first time that you'll be paying interest after the issuance of the bond will be July the 1st, 2013. So for the issuance of the bond, always the same journal entry for a bond issued at face value. You receive cash, right? We're issuing the bonds, we receive cash, 100,000, and we have to recognize a liability in the form of bonds payable also for 100,000. And then we said a bond is a long-term liability because 5 years, right, till maturity. So it's going to be the maturity date is more than 1 year away. For something to be a current liability, we would be paying it off within 1 year. All right, so those are some of the things that you need to be remembering as you're going through. And so for interest, it's kind of always the same or similar calculation. It's what's the face value of the bond. So this 100,000, right, that we just referred to, because that's the, you know, the contractual amount that's going to be paid back. That's also the amount that the interest is based on. So the face value, 100,000 multiplied by the annual interest rate, the 10%, multiplied by how many months out of the 12 months, right, worth of interest are we paying? So when we come to July the 1st, we've had all of January, all of February, all of March, all of April, all of May, all of June. So that's 6 months. Don't get confused, right? It's July the 1st, not July the 31st. So 6 months have passed. And it's also obvious because it says it's semi-annual, so it should be for 6 months. So 100,000 times 10% times 6 months out of 12 months is the interest that we're paying. Interest is an expense to the company because it's a cost of borrowing, of using the money that was given to us. And then we pay the interest out in cash. So cash goes down on the credit side. So that's for July the 1st. And then the question goes on to show on December the 31st, right, the end of the year, we have to do what is called an accrual of interest. This is an adjusting journal entry because we are required to recognize, because we do accrual accounting, we're required to recognize at the end of every year all the expenses that have been incurred and the revenue that has been earned, regardless of whether we've paid it in cash or not. So from July the 1st, right, to December the 31st, 6 months have also passed, but it's not yet January 1st, so we're not going to pay the interest. We're just going to say, okay, there's 6 months worth of interest expense that I have to recognize in the books, because the rules tell me that when I'm doing my end of year financial statements over here on December the 31st, I have to show all the expenses related to that year. So I'm going to show the interest expense again at 5,000, but instead of cash, I'm saying interest payable to be paid in the next year. And this is going to be a current liability, all right? Because we're literally paying it. I guess we're literally paying it the next day, right? Because then on January the 1st, the next day, in accordance with the agreement here that says that bond interest is paid on January the 1st and July the 1st, the next day you debit interest payable to get rid of the liability, and you credit cash because your cash is going down for the payment of the interest to the investors. And then there you have, sorry, I jumped the gun here. Interest payable will be a current liability in the balance sheet because the maturity date is less than 1 year away. So that's how this journal entry goes. Questions for these journal entries? Sorry. Questions, anybody? Okay, so we'll, you know, I know some of you actually do download the stuff that I put up here. So I just want to alert you that this morning I realized that the actual questions that we're doing, that we're doing for this chapter, I hadn't put up yet. So this last document is new since this morning. So if you are on Blackboard and downloading stuff, this thing that I'm opening now is the document I just added this morning. So you wouldn't have had it if you downloaded everything on Tuesday. All right. So I'm going to give you guys like a minute or two to just situate yourselves, whether you need to download this document so you have it ready, or if you want to take a picture of the question. I'm going to throw you in at the deep end now to make sure that people are actually listening with this question, which is basically the same thing as what I just explained over here, right? I'm going to have you guys try your hand at answering this question. So take a minute, maybe till 11:04 or 11:05, take a picture of this. If you don't have the Word document with this information on it, you know, try and find it. But I'm gonna give you at 11, starting at 11:05, I'm gonna give you 10 minutes to do this bonanza question. So I'll read it so long while people, you know, get themselves ready to do it. Bonanza Corporation issued 2 million. So there's the face value, right? 2 million of 8% annual interest rate. 5-year, the term of the bonds that will be paid back in 5 years' time. Bonds on January the 1st, 2013. So it's even the same date as the question we had before. So 2 million though is the face value. Bond interest is paid also semi-annually on on July the 1st and January the 1st. In A, they ask you to prepare the journal entry for the bond issued at par or face value at 100. They all mean the same thing. B, prepare the journal entry for the payment of interest on July the 1st, 2013. C, prepare the adjusting journal entry for the interest accrual on December the 31st. And D, prepare the journal entry for the payment of accrued interest on January the 1st. So literally this question is following what we just did line by line, all right? There's the bond issuance at face value, interest on July the 1st, right? The accrual on December the 1st, and the payment of interest on January the 1st. So by now, hopefully you've either jotted down the question, downloaded the sheet, or taken a picture of the question. What I'm going to do is flip back to this page where the answer is you know, shown. And I don't know if I'll be able to make this smaller so that you can see everything. I think so. It's a little bit small, but I think that helps because you can actually see everything. You've got until 11:16 to answer this question over here, question exercise 1. And then I'll take a hand, I'll take someone who will walk me through their solution. So until 11:16 you have to do exercise 1, which you should have taken a picture of or downloaded the question for yourself from Blackboard. While you work, the people I don't see, I'm just gonna call out names to make sure I'm not wrong. Michaela Cruz, I don't see you here. Don't hear you either. Denisa, I don't hear you. Lance, Narcis, no. Yadira, no. Zanetta, Ramcharan, Walter, and Margaret Rodriguez. Okay. Everybody else, I have your attendance.
Professor, did you call on me?
Sorry, who's speaking?
When?
No, I didn't. I have you. I have you. I'm only calling people that I don't see
Okay.
to make sure that they're not here, but you're here. So I didn't need to call you. I see you. Okay. Okay, you guys have 5 more minutes. Please make sure that you're actually doing the question and not kind of just waiting for me to produce the answer. You want to at least try. Scarlett, I'll take you as soon as we hit 11:16. Okay, Scarlett?
Okay.
Sorry, I think that the class example workings document for chapter 15 was locked to ask for permission, because I just saw Jason, you were asking me for permission. Sorry about that. I just changed
Yeah.
it. Yeah, sorry, I changed it to anyone who has the link. If there's such a problem with any other document, please feel free to ask me for permission. I don't know why that happened. It hasn't happened in my other class, but anything is possible. So sorry about that. All right.
It's okay now, Professor.
Okay. Yes, John, you'll have to, you can, I don't know if you can put the classes in your cart before your registration date, but if you can see the classes, just write them down, the classes you want to register for, and be ready for action on Monday to register.
Yeah, no,
tr-
I can see the class and everything. I just can't like
Yeah,
select it or anything. I can put it in my shopping cart.
Yeah, because we're not there yet. So on Monday, I guess is when all hell will break loose and everybody will be trying to register. So please make sure that you are on it, because there's gonna be a lot of interesting things happening, I'm sure, because people are a lot of people are dead set on staying online, and we don't have a lot of online offerings.
Yeah, I'm looking at that. Like for every single math class, there's not one online option.
Yeah, I'm not surprised by that because am I still, oh, sorry, I thought I was on mute. Sorry, we'll answer the question now in a second. Yeah, I'm not surprised by that because the CUNY administration, the top CUNY, basically came down hard on wanting people to be back in person. So, just double check that it's true that there isn't anything, but it's possible that
Yeah,
that's
no,
one of-
I just checked for both math 115 and math 117, and they're like there's a lot of classes options available, but they're all in person.
Yeah, so then I guess the math department has decided to just go full blown in person. All right, so
Thank you, Professor. You've been very helpful.
no worries, you're welcome. All right, Scotland, let's hit it here with this question. What do you want to tell me for part A?
For bond issue January 1st, 13.
Let me do this. Sorry, A, I'll put here and then I'll put 1/1/13. Yeah,
Debit cash 2 million
yes.
and bonds payable credit 2 million.
Yeah, so it's all the same because this was at face value. Good, next.
On July 1st, 13, interest paid will debit interest expense
Yes,
80,000. I
80
got that by the face value, which is 2 million times the interest annually 8% and times 6 months. We'll get it 80%. I'm sorry, 80.
Good,
Credit cash 80,000.
okay, thank you.
On December 31st, interest accrual. I debit interest expense 80,000. Debit credit interest payable 80,000.
Yes, so it's the same amount because it's just another 6 months of cost. Good,
Yes. Then on January 1st, 14, I debit interest payable
you're
80,000.
getting rid of the liability. Yep.
And then I credit cash 80,000.
So we can see that it's basically exactly the same as what we were seeing in the example that I walked through with you guys in the notes. And what's nice about this chapter is that these journal entries basically stay the same. Remember just that this is the accrual or adjusting entry. So you want to be sure that you understand the terminology, to record whatever interest has been is owing between the last time interest was paid and the date that you are at. Okay, thank you. That's all correct. Does anybody have questions about this? Anything that you need to check with me? Okay, so it's pretty straightforward. That's it for bond issued at face value or par or 100. That's all means the same thing, right? This is issued at face or par or 100. The questions could use all that terminology. It just means that you use the amount given in the question. So we'll move on now to the next bit of work where the bond is issued at a discount. Instead of being issued at par, it's issued at less than par. And this happens, and I'll go formally through the notes, but it happens when the company, and thanks, Scarlett, I'm not sure if I said thank you for answering the question. It happens when the company's interest rate is not that high. It's not as high as the market. You're saying you can't find the questions. The questions are this additional exercises. I was saying I just put them on Blackboard this morning. So for discount, the company, maybe let's say the market interest rate is 5%, but the company is only offering 4%. So people are like, why should we invest, right, with you at 4% when we can go and invest with someone else at 5%? And then the company will say, okay, well, let's make a deal, right? What I'll do is I'll sweeten the deal, even though I'm only paying 4% interest. I will give you a bond that will pay back $100,000 at the end of 5 years or whatever, but you only have to give me $95,000 today. Right, so that's a discount. You basically get the bond on sale because the company can't afford to pay a higher interest rate, but they're willing to, to give you the bond for less money. They just want to be able to borrow. So if the contractual interest rate on a bond is less than the market interest rate, and the market interest rate is the rate demanded by the investors in the market, investors will not pay the full price of the bond because they can go somewhere else, right? It's like when you go shopping, you're looking at, an item of clothing or something, and you're just like, I can get this somewhere else or whatever. The store starts to realize that nobody's buying the stuff and they mark it down, they put it on sale. Investors will not want to pay the full price, so it has to be less. The company will then issue the bond at a discount, which means it's below face value being the amount that will be paid back at the end of the life of the bond in order to attract investors. So they'll have, it's almost like how the stores have a sale sign, in their window. That's basically what's happening. So if the contractual interest rate, that means the interest rate on this bond is less than the interest rate in the market, the bond is issued at a discount. So this is a rule to remember. This is the type of thing that could come up in a multiple choice question where it's saying to you, hey, the contractual interest rate is less than the market interest rate. Will this bond be issued at a discount, a premium, at face, whatever, right? So don't ignore this. And here we have an example. Again, this Candlestick Corporation. Talking about, excuse me 1 second. Talking about issuing bonds at a discount. On January the 1st, 2013, Candlestick Corporation issues $100,000. That's the face value again. 5-year, that's the term. 10% annual interest rate. I'm just repeating this. I know, I'm a stuck record, but it's because when you read this, you need to know what each of these mean. Otherwise, you're going to get confused, okay? Bonds for $92,639, which is clearly less than 100,000. So it's at a discount. Sometimes they might also say that it's issued at 92.6 or 92 or 93. Then you need to know that 92 is less than 100. So this is a discount. And, this is the percentage of face value. That's how we come up to this dollar amount. The bond pays interest semi-annually again on January the 1st and July the 1st. And I was saying that for issuing it for this amount of money, they could also say that they issued it at 92.639. These are all different ways of saying the same thing, which can also become confusing in this chapter because you need to be able to recognize that even though the wording is slightly different, it's still telling you the same information. So now what happens is the company gives up some of the money that they could have received in order to attract investors. So instead of getting 100,000 like we do when we issue the bond at face value, we now get less money today, right? And that again is just because the company is not willing to pay more interest over time. They're willing to take less money today because they've probably weighed up the difference between taking a little less money today or paying more interest over time and decided that it's better to just take less money today. And then still they will pay out 100,000 at the end of the bond's life at maturity. So then the discount of 7,361 in this case, right, is the amount of money basically that the company forgoes that they don't get, but they will still have a liability for it in the end. So discount on bonds payable is a new account that we haven't encountered before. And this is the account that basically picks up this difference between the cash that the company receives, which is less than, you know, what they should receive, and the bond payable, which they'll still pay out at face. And this is the type of account that it is. We're running into this contra business again. The discount on bonds payable is a contra liability account, right? So it's a liability account, but it increases on the debit side. We've already seen a few contras. We've seen contra stockholders equity when we dealt with treasury stock. We've seen contra asset when you deal with accumulated depreciation. So this is the first time that we see a contra liability. To understand it, you have to remember that liabilities increase on the credit side. This is why we credit bonds payable, right? It's going up. A contra liability increases on the debit side. And this discount on the balance sheet, it will be shown as a subtraction from bonds payable. In fact, I think I have the textbook open. I wonder if it will allow me to scroll. Yeah, I haven't been kicked out. All right, let me see. So here's an example of it, right? This company has a bonds payable face value of $1 million, and there's a discount on the bond payable, a contra liability account of 80,000. So the way it gets shown on the balance sheet eventually is that the 80,000 is a subtraction from the bond payable to show a reader of the financials that at this time, right, the actual amount, right, that's owed is 920,000. As time goes by, through a process of what we call discount amortization, which we won't go into, that's like for the appendix, so we don't need to go into that. You'll deal with that when you see me in intermediate 2. Over time, this discount balance gets smaller and smaller until 2027, when the discount will be 0, and the amount that is owed for bonds payable will be the full 1 million. Okay, so again, this means that the discount account doesn't stay on the books. It doesn't exist forever. It actually goes less and less every year, and eventually it disappears, so that what we owe, what we owe is the full amount of the bond payable. And so here's some more terminology. The bond payable, sorry, this is really small. The bond payable minus the discount on bonds payable is what we refer to as the carrying value or the book value of the bond. All right, the bond payable minus the discount is the carrying value or book value of the bond. And the interest, this doesn't change how interest is calculated. The interest is still calculated off of the face value of the bond, okay? You're not going to pay people less interest because they gave you less money. You know, upon issuance of the bond, you're going to still pay them the contractual interest rate, which is 10% on 100,000. All right, so well, in this case, it's 10% on 100,000. So that's how a discount on bonds payable works. And let me see. We can do. I'll push us a little bit. I'll do exercise 2. Just 1 and 2 with you. I'll do them so you can see how the face value compares to the discount, and then I'll stop. We'll take a break, and then we'll do some review after that. Okay, reviewing for the test and making sure that everybody has their questions answered about what's on the test and so on. All right. So what I'm going to do now is go back to this exercises page. Hopefully everyone's found it. See, I know you were telling me you couldn't find it. I hope you found it by now. And I'm just going to do the first two over here. Because number 3 is dealing with a bond at a premium, and okay, and I haven't given you the full background on that. We can pick that up in the next class. All right. So let's read here. Phantom company issues. There's the face value, $100,000 of 4 year is the term, 10% contractual interest rate, annual interest rate bonds on January the 1st, 2013, beginning of the year. Interest is paid semi-annually on July the 1st and January the 1st every 6 months. So this starting to sound really repetitive, but it's good if it's making sense to you, because this is how these questions are written. Prepare the journal entries to record the issuance of the bonds if they were issued at 100. So this is where you need to understand the terminology, right? 100 means face or par value. 95 means that they were issued at a discount, and 102 that we won't go into, today, but 102 means that they were issued at a premium, right? So for today, we'll just do the first two, and then next time I'll show you what the balance sheet looks like and so on. So we already know the answer to A1 because we just did it previously, but I'll indulge us also. Exercise 2, part A, number 1, right? The bond is issued at face. And I'll go back to the question here in a second in case people still need to take it down or whatever. Unfortunately, these questions are in a Word document, so I couldn't really drag them over into the Excel spreadsheet. I mean, I can, but when I try to paste it, it all comes out in one line, and then I have to do all kinds of formatting, and I just kind of don't have the time for that. So, have these. I know everybody doesn't have a printer, but if you at least have everything handy that you need on your computer, that does help. Or just try to follow what I'm doing. Have a system though. Let me just, get on a soapbox for 5 seconds. Have a system of how you navigate between the materials that you are given in your class, and that things aren't just dumped somewhere, because you are going to need to find them when the time comes for tests and homework and so on. So we're doing 100,000, and it's at face value, right? So that's going to be basically the same as the example that we had in the class. You debit cash because you're receiving cash from the investors, and you credit bonds payable to show that you owe this money that will be paid, in future. So that's A1. And then A2, which is issuing the bond at a discount, right? 95. So this means that you're only getting cash that is 95% of the face value of the bond. So we're accepting less cash today in order to excite people about investing with us. Okay, we're accepting less cash today. So that people will actually invest with us. So 95,000, because it says 95, it's 95%. 95,000 is what we end up receiving. Now, what I can tell you is, and this is important, the credit to bonds payable, whether you do issuing at face value, issuing the bond at a discount, issuing the bond at a premium, the credit to bonds payable will always be the face value. I repeat, whether we issue the bond at face, at a discount, or at a premium, right? The credit to bonds payable will always be the face value. All right, so that's a rule. So if you didn't know how to build this journal entry further, you could at least credit bonds payable with 100,000 and know that that answer is correct. Now we know that the dollar amounts of debits and credits have to be equal. Clearly, we are not equal over here because we've got 100,000 on the credit side and only 95,000 on the debit side. So there's 5,000 missing, right? We know from our previous discussion that this new account has to be used, the contra liability discount on bonds payable. And so that's new, right? So that's how we record it. And like I said, over time, oops, sorry, I didn't mean to do that. Over time, it will get smaller until it doesn't exist anymore. And we will just pay people back 100,000 at the end of the life of the bond, even though we only received 95,000. So that's how the discount works. For the people who are curious about how the premium works, it will just be that you receive cash of more than 100,000, and then the premium is a credit account. In fact, you can see it over here. I won't go into it because I promised that I will see there. The premium is just a credit, and the cash goes higher than face value. And we'll pick that up. We'll pick up there for the next class. I'll give you a break now until 11:46, and then for the last hour, I'll just go into some parts of 13 and 14 to make sure that we're feeling kind of okay for studying this weekend and being able to do the test and quiz. All right. So you're on break until 11:46.
Professor, I have a quick question.
Yeah, go ahead.
Someone said earlier that
I'm just gonna pause the recording, but thank you. Thank you. All right. So in this last hour, I just want us to revisit everything that is happening for the test and the quiz. And I'm going to just go over a few theoretical concepts, and then I'm actually going to work through some examples with you that are, similar to what you will see. So I know this is like old news, but just to remind you, everything starts on the 26th on Tuesday. Yes, the homework is also due that day for chapter 14. That's usually what I do. The start of the testing window coincides with the end date for the last chapter in that test. But I'm hoping that people will be, finishing their chapter 14 homework before then. I will go through things that come up in the chapter 14 homework also in case people are stuck or whatever. That's not a problem. 15% of your grade for this test and the quiz is 3%. I have said this before, but I want to just reiterate that you need to do the quiz before you do the test. Specifically because I've set up the quiz so that it's covering a lot of the kind of hot topics that are going to be coming up in the test. And the quiz gives you a good understanding of how, I know it's only multiple choice, it's not a full exercise, but I mean, if you're really struggling to answer questions on the quiz, it tells you even more that you need to study some more before you start the test, and the quiz is kind of lower stakes because it's only 3% versus the test being 15%. Once you start, you can't I don't want to say you can't stop, but I mean, once you start, you want to finish this thing in one sitting. I gave you guys more than enough time, 120 minutes. You probably only need about 30 or 40 minutes, but I want you to really take your time, be thoughtful about it. Don't be distracted and try and get like the maximum amount of points on the quiz. Michelle, you have a question?
Oh, no, as you was talking, I actually read the answer to the question. I was gonna ask if it's open until on Tuesday, but it says until the 2nd. I see it there.
Yeah. It's a week. You guys have a week window. You can take the quiz and the test whenever you want to. You just have to, once you start it, you have to finish it. So if you decide that like Thursday, at 1 o'clock is when no one's in the house and you have time and whatever, then that's when you do it. It doesn't matter to me as long as people don't think they can start the thing on the 2nd. Just before it closes, and then tell me that the thing kicked you out. Like that's nonsense. Okay, you got to make sure that you start way before 6 o'clock on the 2nd, if you even want to leave it so late, because that's it's asking for trouble, because that's when computers break down and whatever. With the quiz, your point potential will drop. after the third attempt, even if you get, I mean, it's 4 options, right? A, B, C, D. So even if you get it right on the 4th attempt, you will only be able to get 60% on that question. So please don't contact me and tell me that you got the answer right, after your 3rd attempt, but your grade is only 60%. I have to penalize in some way, because someone who gets the question right on the 1st go around can't have the same grade as someone who gets it right on the 4th attempt. All right, so please watch out for that. Remember, I told you that the Wiley rep said that, especially when it comes to the test, even though there are supports that I offer, where you can choose to receive help, you can opt out. So, you can use your attempts and try to get as many points as possible with the test. But with the quiz, once you start clicking A, B, C, D and submitting your answer, it is counting against you. All right. There's no way to opt out of your points dropping down to 60% for the quiz. With the test, you can choose not to take help if you don't want your grade to go lower. Again, way more time given than you would ever need. I put 4 hours down, all right, because sometimes people are struggling, especially because it's new Wiley Plus. I know that there might be navigation issues. People are panicking because they don't know how to click on whatever. Please relax, take a breath. You have more than enough time to do the work. 4 hours doesn't mean that you don't study and you think you can just, page through books and find answers. That's not the point. I just don't want timing to be like a big issue. But remember, the more attempts you make at the questions, the more time is going to go. I have had people that even with the 4 hours, they run out of time because they think they have so much time and they're doing multiple attempts and they're, like just chilling and whatever. Please, people, just focus and try and get this done. Like I said, there is help. Like after the 2nd attempt, you do get some access to accounting terms. You don't have to take that. After the 3rd attempt, you can see the solution. If you like, the solution means how they calculate the thing. You don't have to take that. And lose the 15%. That's what the rep told me. It will pop up and say, at this point you can do ABC and you can just say no. So you could, after the 3rd attempt on the test, you could still get 100% on a question, but please just make sure that you aren't shooting yourself in the foot by doing multiple attempts and then running out of time on the rest of the questions. I would strongly encourage actually studying and not treating this like an open book test and thinking you can just kind of cruise in and start answering based on what you see on homework or something, because even though the questions look the same, it's not the same numbers. You still have to be able to calculate the numbers. You still have to be able to use some of the general thinking around it. Shafak, it looked like you had a question, but then your hand went down. So I know I'm going to assume that I answered your question somehow. If I didn't, you can tell me. There's also 10 multiple choice questions on the test, but the difference between the quiz and the test is the quiz doesn't have like, I think the students usually call it definitions. Like there's not theory questions in the quiz. The quiz is calculations, journal entries, and things like that. Whereas with the test, some of the multiple choice questions are theory, like, what's a advantage of a corporate form of business, like some of those types of things are going to come up, and there are some calculations and applications and so on. So please don't completely ignore the theory, like, the different characteristics of a business, or, stuff to do with what is retained earnings or things like that. You may find that there are questions like that in the test. Then you've got seven, which is a lot, right? But some of these are very small, but you do have, or short, I should say, but you do have 7 exercises. So please make sure that you don't, faff around on exercise 1 to the point that you've used up 2.5 hours of the paper, and then you're running through trying to finish the rest of the stuff and you just can't get there. All right. So exercise 1, and I'll do something similar now with you, to review, but this is, and in fact, this is maybe more useful to show you than to tell you. The first exercise, excuse me, sorry, I'm still struggling with, these kids, they come here with a sniffle and then they kill me. They bring whatever germs from school, and then I'm also sick. Guys, problem 13.1, A through C. You see what I'm showing you, right? This, oh, sorry, Shafak, I didn't see your hand was still up. Go ahead.
Yeah, I just wanted to ask the example, like the 4 hours that we have includes our test and the quiz both, right?
No, the quiz is a separate activity. Like you can do the quiz on Tuesday and you can do the test on Friday. The quiz is a separate 10 multiple choice questions. You have 2 hours to do that. You can do it whenever you want. It's independent of the test. All right. The test has its own 4 hours of time, probably half of it that you don't need. But, you know, again, I'm doing it because it's a new platform that we're working with. There's all kinds of little niggles, and I don't want people to run out of time because they're struggling to navigate and whatever. So does that answer your question? Two separate things.
For the quiz separate and 4 hours for the test separate. Okay.
And the quiz is separate from the test, and you don't have to do them both on the same day. You can say, I feel strong enough to do the quiz today, but then you do the quiz and you're like, oh my word, I thought I knew what was going on. I need another 2 days to study. You study, and then you can do the test on another day. This is why I'm saying don't leave everything until the 2nd of November, because you may do the quiz and realize that you're in trouble, but then it's already the due date and you don't have enough time to do more studying. So back to, you know, the studio, stock issuance, journal entries, general ledger, and balance sheet. What does that mean? That means that you are getting a question that is going to look like problem 13.1 A through C. Okay, so please make your peace with this question or a question like this, because it's going to come up. If you didn't do the homework or you've half baked it, I'll say baked instead of the other way that you can say it, then you got to go back and you know, and figure out what you need to know. I will, you know, run through an example that is similar in a minute here. Treasury stock purchase and sale. We had an example of that in the homework as well. Yeah. Brief exercise 13.7. I'm not saying the question is going to be exactly the same, but guys, I'm saying you've seen the stuff. Don't mess around and not study or just think you can print this out also and you'll somehow know how to do this. That's not the case. You need to actually understand how to do it. Cash dividend declaration and payment. This is chapter 14 work. You have this in your homework for chapter 14. Just bear with me for a second here. Get to chapter 14. So this is the homework that is coming due that people should hopefully already have started, because we've been done with chapter 14 for what feels like ages. I know it hasn't been ages, but it feels like it. All right. So this is, you know, a question that includes issuance of stock, but there are other questions here that's, you know, just dividends, right? So I'm talking about cash dividends. Let me see. Yeah, and then the next one. Okay, so I'm getting ahead of myself. So practice, you know, the first and second question is talking about cash dividends, and then I'll come back to stock dividends, but the allocation of dividends between preferred and common stock. If I'm just going back to the homework, I believe it's the third question is where this already starts. Yes, right. So allocation of dividends between preferred and common stock. I'm not giving you the homework for nothing. All right. Not only does it count 5% of your grade, but it's also a beautiful primer for doing well on the test. Another allocation question, right, of dividends between preferred and common stock. People usually blow this question on the test. Okay, it's for whatever reason they haven't studied enough. There's too many words. There's so much terminology. It usually does not go well if they didn't study. So please make sure that you spend time on it. Here's your stock dividends question. Stock dividends is coming in, right, as after cash dividends, stock dividends. So please spend time there. Then the next question, there's another stock dividends example. This one is the retained earnings calculation. That's the last question on the test, will look like that. And then the income statement, there's two, sorry, not this one. There's two retained earnings, but there's only one income statement. Then there's obviously example I did in class. A question like this will be on the test also. So now you can see, you know, how much work it is. So when I say, you know, 4 hours or whatever, I mean, I made it the test probably a little bit longer than I would make it if we were in person, because you'd only have 2 hours to do it and you have to do it with pen and paper. But, you know, manage your time. Please don't spend 3 hours on exercise 1 because, you know, you don't know what's going on, or one thing is wrong and you can't figure out your error. Move on, okay? Move on to the next thing and come back if you have time left over. Please remember that you can click save for later. You don't have to click submit if you're not ready for the system to check your answers and see, you know, if they're correct. But please don't do a whole question and then move away from that question, because it's not going to save your work. Okay, so you've probably seen this with the homework as well, where, you know, in the question, when you're busy with the homework, you can click save for later and go out and come back in. But you should make sure that you either submit your work or save it. When the deadline comes, that's November the 2nd at 6 p.m. Whatever has been saved, if you haven't yet submitted, it will auto submit. But I highly recommend that you submit your work when you're done with it for the test and the quiz, because you know, the rep told me that in rare instances, you know, not all of people's things auto submitted. So we don't want to get into a lot of administrative drama. Save your work if you're not ready to submit. Once you're ready to submit, please do it. If you do a question and you maybe have one small little error and you really can't figure out what it is and you don't want to take the help because you don't want to drop your points, please move on to another question. That's the thing with accounting, right? You get more points by doing more questions, and you can always come back. Maybe your brain will rest a little bit, and when you come back, you can figure out what the error is that is holding you back. If you're having any type of mechanical or technical issue while you are doing the test, you know, a few things. One, make sure you're using, you know, a browser, like they usually recommend Chrome, but that you've cleared the cache before you even start your work. Make sure that all the pop-ups are enabled for Wiley's website, because that could also cause you to get stuck, to have issues with it. Make sure that you have a proper internet connection, because if it's intermittent or something, it may end up being that it's actually your internet connection that's kicking you out of Wiley. You can, unlike the legacy Wiley, with the new Wiley, you can go out and come back into the test and the quiz. However, the clock does not stop ticking when you go out. So if you say, oh, I'm going to go out of I'm going to save my work and I'm going to go out of the test because I have to go and do something for 30 minutes. When you come back, you'll see that you've lost 30 minutes. All right, the clock will just keep ticking regardless of whether you are out of the test or the quiz or not. It doesn't even matter if you shut down your computer. The clock is ticking at Wiley. It's not ticking, you know, locally where you are. All right. So please be sure that the time that you choose is a time when you can finish the work. I don't know that I'll be able to add time for people, because in a previous semester, when people didn't listen to me and they started the test and then they thought they could go out of the test and come back and just pick up where they left off, I tried to add time for people, and the system was so sluggish. We struggled for 2 or 3 days to add time, and then in the end I had to clear all the work that the person did, and they had to do everything over again. That was the only way for them to be able to, you know, get the time back, and no one has, you know, the time or the bandwidth for that. I know you don't. You guys are working, you're busy, and so on. So please just make sure that you organize your life so that you can finish the test you know, in the time allocated. If something happens, like you got shut out and you can't get back in or something, there is Wiley technical support. There's live chat people who might be able to help. Of course, you can contact me, send me a screenshot with what the problem is. But guys, I am accounting support for the most part. I'm not really Wiley technical support. So more often than not, people send me these things in the middle of the night. They're like, oh, Professor, I got shut out. I don't know how to get back in. And then all I can say is I have to contact the Wiley rep and ask them, you know, to help you. You're actually better off just speaking to a live chat Wiley person who might be able to get you back in. All right. So do contact me, but understand that I can't see your computer from where I am. I'm not tech support. Does anybody have questions about just the 7 exercises or the 10 multiple choice questions or whatever before I just talk about topics a little bit and then actually do an example with you? Any burning questions?
Study for the quiz.
Sorry, I didn't hear you.
How should we study for the quiz?
Yeah, I mean, it depends on how you normally study. Like the studying for the test and the quiz, I don't really separate them too much from each other in the sense that the quiz is going to be, calculations and talking about, how do you record something and so on. So I would, the same homeworks and stuff that you're going over and classwork and so on, if you know how to do that work, you will know how to do the quiz. I don't know, back in the day, and I don't know if they stopped this, I have to check here quickly. Back in the day, oh great, I got thrown out of the textbook. Wiley used to, in the textbook, they used to have a few practice multiple choice at the end of the chapter. I don't know if they still do that, because at one point it looked to me like they had stopped doing it. Let me just, sorry, just bear with me. I'm just trying to see. Yeah, this is what I'm talking about. Do you see this? Practice multiple choice questions.
Mhm.
So I would study obviously first, and then if I were in your shoes, what is going on here? Okay, I would then try and do as many of the practice multiple choice questions as you can, but also know that even your practice of the classwork questions and the homework questions is going to help you to answer the multiple choice questions for the quiz. But this at least gives you that, that feeling of you have to select an answer and then check if it's right. And I believe, if I'm not mistaken, I have to kind of refresh my memory because I'm more used to the physical book than this online business. But I think near, oh yeah, that's the solution for that. I know that somewhere in the mix here is going to be the solution for all these multiple choice. Oh, the answer's right here below it, sorry. Yeah, so you have the answer and everything. So just try and answer the question, and this, you can do that for 13 and 14. So hopefully that helps. Any other questions before we move on? Okay, so you know already which topics I'm focusing on for the actual exercises, but just to remind all of us, I'm just going to fly through a little bit what was covered in 13, and then I'm going to do an example related to 13. Not going to re-lecture any of the material. I don't think that's helpful to anybody. You can always go watch the lectures again, or you can just read, right? So we started with some theory around the characteristics of a corporation. You could just see, if you looked closely at the multiple choice that I had opened up, you could see that there were sample multiple choice questions that deal with this material, like what is a major disadvantage of a corporation, right? And so you probably think something like double taxation, because they tax the corporation and they tax the dividends that the corporation pays. So here's all the, the characteristics of a corporation. Make sure you read them, make sure you understand what's good and what's bad about them. This additional tax is what I meant by double taxation. Forming a corporation, I mean, this is not really something that this is more like law classes. They would worry about testing this a lot. I'm more concerned with this next with this. Obviously, we know that something is common stock or preferred stock, but the stock issuance is the crux of this chapter, right? Issuing common stock, issuing preferred stock. Understanding that authorized stock means the number of shares that the company is allowed to issue. What has actually been issued is the issued stock, and then what is outstanding is what is being held by outsiders, right, outside of the company, and treasury stock is what's held inside the company. This is all terminology that you should, by the time you're done studying this chapter, that you should be comfortable with. And then market price of the stock, we know that that is what the stock is trading at right now, right in the market. And that is not going to cause a journal entry to happen at the company, right? If I sell my Apple stocks to Shafak, you know, Apple doesn't have to make a journal entry. Apple only makes a journal entry for the initial public offering when they first issue the stocks to the public. Any other purchase and sale on the secondary market is not their problem. Par and no par value stocks, we spoke about the fact that we use the par value to record the common stock number. If there's no par value, maybe there's a stated value which we'll use. And if there's absolutely no par value, you know, we'll see later on that you just put you put the entire amount of cash into common stock. And we spoke a little bit about par value and the fact that it's kind of an antiquated or, you know, a leftover legal terminology for an amount of capital that the company is not allowed to distribute, but it's very arbitrary and it really doesn't mean that much anymore. And so for corporate capital, we know that there's a difference between the paid in capital, which is actually contributed from outside. That's the capital stock, which is common stock and preferred stock, and also the additional paid in capital. So paid in capital in excess of whatever, right? Either common, either par or stated, and common or preferred. Then you've got retained earnings, which is the earned capital that represents net income, which the company has kept back and hasn't distributed. And so and we'll do examples now. When we're accounting for the issuance of the stock, it can be for cash and it can be for non-cash assets or services. You need to be able to handle all of that. Year over year, I tell you, right, how to calculate what goes into cash and what goes into common stock. The cash takes the issue price of the shares times the number of shares. The common stock takes either par or stated value times the number of shares, and the difference goes into paid in capital in excess of par or stated value. If there is no par value, cash is the issue price times the number of shares, and common stock is the same. And remember, this, all of this applies to preferred stock as well. You could substitute the words preferred stock and you'd be doing the same journal entries. If we have a stock issuance for no non-cash assets, we have to remember that the transaction should be recorded at either the fair market value of what is given up, so that's the shares that we're giving up, or the fair market value of what is received, whichever one we can figure out more easily. So if the shares are traded on the stock exchange, you should use the fair value of the shares. If they aren't traded, but maybe it's land that has been valued and it's worth a certain amount, then that's what you use. We have multiple examples of this, you know, in the work that we did. For stockholders' equity section of the balance sheet, I've told you a number of times here that you probably want to have a quick reference to a document that has something, you know, like a reference next to you or something, so that you don't panic if you are being asked to build a balance sheet. If we were in class, I would give you a template and you just have to fill out the numbers and know what to add to what and so on. But since you're going to be on your own, make sure that you don't plan to just access the textbook while you're busy with the test, because that may not be allowed, right, in the system. So what you want to do is just have this nearby as a reference. It shows a full stockholders equity section of the balance sheet. And remember, the homework problem asked you to do the paid in capital section, right? So so be careful about whether the question is asking you for stockholders equity or paid in capital. And this is how you start. Capital stock, in Wiley, they don't do all these extra words. They just do preferred stock and then common stock. Remember, we did have that issue where people were allowed to put common stock first, but the way you should be doing it is list preferred stock and then common stock. The same with the additional paid in capital. You're listing preferred stock and then common stock. Notice you need to practice to know what is being added to what. And remember that treasury stock is being subtracted, okay? And make sure you understand what makes up these like in between or subtotals, what's being added together to get to the subtotals. Because I think, you know, you can have a sheet next to you that is a balance sheet and you're like, okay, great, I'm going to be able to just ace this. And then suddenly you're not sure what is being added and subtracted, and then it just becomes a big mess. So use whatever you find, or this illustration 1311 is a good bet. And then accounting for treasury stock, right? We said that it's the cost method. So you base it on what the treasury stock actually cost is what we debit treasury stock with. Treasury stock is a contra stockholders equity account. So it's going up on the debit side. And the credit when you buy the treasury stock is to cash. And then, you know, we've done some journal entries for selling the treasury stock again. And, you know, I have an example on the sheet that I have here for us to work through. And when you sell the treasury stock, you have to credit the treasury stock with the same cost per share that you used when you debited the treasury stock for the purchase. This is normally where people get this wrong. You're still using the cost method. So you have to credit treasury stock with the same amount, the same cost per share. I shouldn't say amount, I should say the same cost per share, because you're not always selling you know, the same shares, the same cost per share that you had bought the shares at. That's normally a place where people trip up. And I told you preferred stock, same account, same process, just a different account name, same as common stock. That's the flash through the material. Don't panic. Don't think, oh my word, I only caught about half of that or whatever. That's fine. This is just to jog people's memories and maybe even to scare some people a little bit, not intentional, but to scare some people into like, oh my word, I don't remember that at all. Like I better start studying, right? So don't worry. It's my evil ways, right? As Halloween approaches, I'm more just trying to shock for those who need a shock, to realize that they have to go and review. And if you didn't follow everything, it's fine. I'm going to try and do what I can in this question. This question is for those who, you know, for curious minds. Remember, I put this test prep. It's always been here. There's practice questions for the 2 chapters. If I don't get through everything, it's fine because the answer's already here. Although I have seen that I have to amend some of these answers, so I'll fix that for you. But this is just an example that is basically taken from the textbook, an older edition of the textbook. And I'm just going to journalize, you know, some of the transactions for you. I'll see how far I get with actually posting them, you know, to the ledger and so on. And then there's a balance sheet. If people are feeling really worried or whatever, you know, if in terms of like you're not coping, I'm happy to continue reviewing a little bit on the 26th, but I just want to say that this review is not a substitute for your own studying. So you can't be like, yes, I need another review because I don't know what's going on. You're going to have to make sure that you get up to speed. Okay, so let's look at this example. Again, it's on the test and quiz information tab in Blackboard, but I'll just toggle between the example and this document I will paste into the test and quiz information prep tab as well. I haven't pasted it yet. So let's see. Peck Corporation is authorized to issue 20,000 shares. So remember what I was just saying, authorized, you need to know what that means so you don't get confused and think that you need to do something. Authorized just means you're allowed to issue this amount of shares. Nothing needs to be done yet. Of $50 par value, so now you know that there's a par value, 10% preferred stock. So all this information relates to the preferred stock of the company. 10% is only needed when you are doing a dividend calculation, right? So don't use it for stock issuance. And 125,000 shares of $5 par value common stock. So there's 2 types of stock here. There's $5 is the par value for the common stock. On January the 1st, 2014, so most likely the beginning of the year, the ledger already contains the following balances. So don't get thrown off here. This just means that these items or these amounts were recorded previously, okay? During 2014, the following transactions occurred. So this is really what you should be focusing on for, this is part A, where it says journalize the transactions and the closing entry for net income. So by now, I'm sure some people have already forgotten what that means. The closing entry for net income was the first thing that we ever did in chapter 13, okay? It was, and if you go into the into the chapter, and you read, you'll see, I mean, or if you just do all the class examples that we did, it comes up, just making sure I'm not going past it over here. Closing entry for net income, debit income summary, credit, retained earnings. All right, so that's what they mean by that. So I'm going to start doing journal entries here. You can follow along with me, see if you remember what's going on. So debit and credit, I need to put in. And this is going to be, let me see what the date is here, February the 1st. And this is P13-4A. That's, you know, how it's written at the top of the question. So I'm just going to stick with that. February the 1st, issued 2,000 shares of preferred stock. So we already know the credit goes to preferred stock for land. So this is a non-cash stock issuance having a fair value of 120,000. So they've made it easy for you because they tell you what the fair value of the land is. Remember the rule that when we issue stocks for non-cash assets, we have to use either the fair value of the stock or the fair value of the asset. We don't have a fair value for the stock. So now someone who didn't read the question properly is going to be like, okay, I know the debit to land is 120,000. Great. Now, all I see is 2,000 shares. So how do I know what to put for preferred stock? Should I just put 2,000? You could do that, but it would be wrong because what you should have remembered is that the formula is the number of shares times the par value. So you've got to go back up and remind yourself that the par value for preferred stock was $50 per share. So now I go land, right, 120,000. Now I've got to credit preferred stock. And over here, the credit is going to be, was it 2,000 shares? Yeah, 2,000 shares times $50 per share. Number of shares times the par value, okay? So that's the preferred stock. Now we can see that there's an issued dollar amounts of debits and credits don't balance. We already know that the difference is on the credit side. And this is the account that you already know, right? Paid in capital in excess of par value. I'll have to make this thing bigger. Preferred stock, okay. Right. Land looks a little bit lonely there, but maybe I don't need to go that extreme. Okay, I'm now wasting time trying to get this perfect, which is not in our best interest. All right, so this is the issuance of the stock for non-cash assets. All right, any questions there? Anybody? Check the chat, nothing is happening in the chat. Okay, so March the 1st issued 1,000 shares of preferred stock for $65 per share. So this is an actual cash issuance of shares. So now you remind yourself what we said before, right? That when it's cash, the cash will take the number of shares times the issue price. And now you have to remember the $50 is the par value again. Notice how this thing compounds. If you didn't study or you didn't read the question properly and you didn't find the $50 for the first part, now in the second part you're going to get the answer wrong again because you're not using the right par value, right? So make sure that you are reading the preamble, the beginning of the questions as well as the actual question. So 1,000 shares, $65 per share, and the date was March the 1st. Okay, so March 1. So we're going to go with cash. It's 1,000 shares times $65 per share. Right, so that's obviously 65,000. And then we're going to go again with preferred stock. And the preferred stock is going to be 1,000 shares times 50. So that's 50,000. And we will end up with paid in capital in excess of par value. And it's going to be a plug number, right? The difference between the two numbers. So kind of similar approach, except that here we had to use the fair value of the land. Over here, we use the number of shares times the issue price of the shares. Stop me if you have questions or anything. Doesn't make sense. I'll keep moving. Issued 6,000 shares of common stock for cash at $7 per share. Okay, so that's the issue price. That's the number of shares. Here you got to be careful now that you don't confuse the $50 and the $5. Common stock is a $5 par value, right? So I'm gonna go, fairly quickly because we're getting used to how to do these questions. So it's cash. It's going to be 16,000 shares times 7. That's the issue price times the number of shares. And then you're going to go common stock now, right? Because you've got to read the question properly and make sure that you're using the correct stock account. That's going to be 16,000 shares times 5 because it's a $5 par value. And then you're going to have paid, right? The classic paid in capital, in excess, and they're all par, not stated. So, you're okay with this, but you've got to do common stock. So this is another place where someone could get stuck in Wiley and lose points or start getting frustrated because they're like, why isn't my answer correct? Remember, if it's a stated value, you have to choose the account that says paid in capital in excess of stated value. Also, you have to know which type of stock you're working with, because if you put preferred stock here, the system is going to mark your answer wrong, and you're going to keep, thinking submit, and run out of run out of attempts. And then it was a simple thing, like you should have put common stock instead of preferred stock. So please pay attention to detail. Now, on September the 1st, there's a little bit of a wild one here. Issued 400 shares of preferred stock for a patent. A patent is an intangible asset that gives you the right to produce something, yourself, whatever that thing may be. Let's say, like a smartphone or something. They have certain patents on functionality. The asking price for the patent was 30,000. So that's just, what it was advertised for. But now it's saying that the market price for the preferred stock was $70. And the fair value for the patent was indeterminable. So now, although you're probably not getting a patent on the test, I mean, I already told you what your question will look like. But the point is you have to employ the same thinking that you had before. This is issuing stock for a non-cash asset. So we either use the fair value of the stock or the fair value of the asset. It says that the fair value of the patent can't be determined. So we have to use the $70 for the stock, and the number of shares is 400. So that's how we're going to record the patent. Again, the patent is an asset. So it's almost like land, how we debit land, but we just say patent. So it's going to be September the 1st, right? There's the patent, and it's going to be recorded as 400 shares times $70 per share. That's the amount there. And then this was for preferred stock, so it's going to be a $50 par value. So let's go with 400 times 70. All right, and then we're going to go with preferred stock. So it's going to be 400 times the $50 par value. And then you have your same paid in capital in excess of par value for preferred stock. And that's going to be the plug number of 8,000. All right. So even though that looked a little bit tricky when we started reading it, in the end, you realize that it's still just an issue of stock for a non-cash asset, right? And that asset is a patent. And so now we come to the last stock issuance, and then we have the closing entry. So issued 8,000 shares of common stock for cash at $7.50 per share. We know that the par value is 5. Notice how it's repeating now, right? So if you know how to do this, you're halfway there. So it's December the 1st. You've got cash, right? And going back, make sure we're taking the correct amounts, 8,000 at $7.50. number of shares times the issue price, that's what goes into cash. And then your common stock is the number of shares times the par or stated value, if there was a stated value. So it's going to be 8,000 shares times 5. 5 was the par value. And then you've got your paid in capital in excess of par, sorry, for the common stock, and you plug that number. $20,000 amounts of debits and credits have to equal. And then for December 31st, it's going to be that last entry that they're asking about, the closing entry for net income. Net income was 260,000. The closing entry is a known entry, like you can basically memorize it. It's 260,000 debit to income summary, 260,000 credit to retained earnings. This again is the first journal entry that we learned when we started chapter 13. So once you've done this, you've now recorded all the journal entries that were asked of you in this exercise. Notice how I didn't record anything to do with beginning balances, right? Because those were recorded previously. So then it asks you to enter the beginning balances and post to stockholders' equity. And we'll do that now. But before I do that, I just want to make a note here again that once you've done the journal entry, you've really done the hardest part of the work, because you basically don't have to think again for posting, because posting is just a copy and paste from the journal, right, to the ledger. So if I look at this, what I mean is, first of all, they asking, let me check. See, it's only for the stockholders' equity accounts, and I think the homework was the same. If they're asking only for stockholders' equity accounts, it means that every single account that you're working with is going to have a credit balance. So the beginning balance goes on the credit side, and every transaction that we've done so far, you can go back in the journal and you'll see that hits a stockholders' equity account was a credit. So literally every item that you will post will go to the credit, meaning the right-hand side of the accounts. It's not, it's basically almost, you can almost go into a trance and just do it and you'll get it right. Okay. Nothing goes on the debit side of the accounts. So I may just do one or two of them and not all of them, depending on the time. But let's see where we start. So we'll put the preferred stock account first, just since it's probably going to be first. I'm not going to do the 3 column. I think you guys get, even in your in what do you call it, in Wiley, you get just a kind of a T account format. So I'll just stick with the T account. And I'll start with preferred stock. I'm just gonna, demo, make sure that everybody understands what's going on. So this is the posting to the ledger. This is the debit side. This is the credit side, because it's stockholders' equity. This is the minus side, and this is the plus side. Right, the normal balance on an account is on the side where it increases. That's why when we go look for the beginning balance now for preferred stock, the 500,000 balance over here, we are going to put that on the credit side of preferred stock. Okay, so I think in Wiley they normally have a drop down, and you have to put BAL, and the balance is 500,000. Again, coming from the question, and sorry, the question doesn't tell you put it on the credit side. Your knowledge of accounting and of the fact that a stockholders' equity account increases on the credit side should be what pushes you to put that on the credit side. Now that we've done that, we have to look for other instances or any instances in the journal where preferred stock comes up. So it's in the very first entry for February the 1st, there's already a credit of 100,000. So I'm just pulling this number and going into what we're approximating to be the ledger, and crediting right? This T account / ledger, crediting preferred stock with 100,000. Nothing is happening on the debit side, and that's fine. Okay, nothing needs to happen on the debit side. So I have posted the 100,000. So I need to move on to the next thing. On March the 1st, preferred stock as a credit of 50,000. So I'm also going to credit it over here with 50,000. I probably should have made this line a little bit longer. All right, and now I go back and check to see if preferred stock shows up anywhere else. So I've posted that, so now I've got to post this 20,000. That's where you have to pay attention to detail because we don't want to double count entries either. So September the 1st is 20,000 for preferred stock. And I think that's it. Yeah, because the rest is common stock and the closing entry. So then you just balance it out. We already know that if all these numbers are on the same side, it's just an addition. So the balance on preferred stock is 670,000. This is what goes to the balance sheet. Okay. This is the number that goes to the balance sheet, not the 500,000 that was over here, not some intervening number. It's the ending balance in the ledger is what's going to go in part C to the balance sheet. All right. And so, you know, if we do common stock, which we can, I mean, I'll just do it quickly, but this is going to get old pretty soon because I think you guys are able to follow what's happening. So we'll do one more, we'll do common stock. Right. Same idea. This is why I said if it's asking you to do stockholders equity accounts, it's going to just be, it becomes a little bit tedious. It's going to be the same side of the account. Everything goes onto the credit side. So if you're looking for common stock, it said that the beginning balance is 350,000. So I'm putting the 350 in there. And then I'm going to go up in the journal and try and find where common stock came up. Okay, there's 80,000 on July the 1st. So I'll post July the 1st, 80,000. Right? And then go look again to see if I can find anything else. Sorry, I've not gone too far. There 40,000 on December the 1st. Okay, so December the 1st, 40,000. Okay, that's it for common stock. So just calculate the balance. You don't want to do the sum for me up there, fine. 470,000. So that's, you know, that's what ends up going to the balance sheet. And I mean, again, all that's left really is the paid in capital accounts and also the retained earnings. I don't know if people, do you guys just want me to push through and finish all the ledger or move on to try to build the balance sheet? Any takers, anybody who feels strongly either way? Everybody asleep right now?
Nah, I'm here. I'm just.
You're like,
my
what
brain.
the heck? Yeah, you're like, what the heck just happened, right? Okay, so let me make a deal with you guys. I can stop here and open it up for me to repeat things or to explain something. And what I'll do is, I mean, all the answers are already up for you guys on the test and quiz prep, but I'll also just show the balance sheet just before the end of the class, just so that you can see it. But I totally get it. It's information overload to some extent. Yeah, you're saying either way, it's a lot. So let me give 2 minutes for processing. Right, for processing what happened. And then in that 2 minutes, also if people have questions or you want me to repeat something, happy to do that. And then in the last 5 or so minutes, I'll just show you the balance sheet that relates to this. And we can discuss that a little bit. So this is our time to reflect, okay, until 12:40, unless someone has a question for me already.
Professor, on Monday, we're gonna keep going with chapter 15, or we're gonna do a review at the end?
Am I seeing you on Monday? You mean on Tuesday?
Yeah, Tuesday, sorry.
I'm like thinking, because I'm looking at the dates on my schedule and I'm like, huh?
I always
Yeah,
get confused with
No, it's
that.
fine, it's fine. No, I still owe you some more review because I was hoping to also do a, what do you call it? This allocation of dividends between common and preferred. So what I'll probably do is I'll pick up in the first part of the class, I'll pick up pick up the review again. And then for the second half, I'll push on with chapter 15.
Okay.
So it's 12:40. Does anybody have something that they need me to repeat or something that is mind-boggling here with these journal entries or the posting to the ledger?
Professor, so for the test and quiz, it doesn't matter if you like pause it for later, like everything's going to be due on the 2nd November, right?
What do you mean by it doesn't matter if you pause it for later?
Like you go on it and then like you take a break and then you come back, like everything's gonna still be due November 2nd.
Oh, there's a bigger issue than that. If I'm understanding your question, let's be very clear. If you go tomorrow morning at 9 o'clock and the test is open and you start doing the test and you decide you're going to stop because you're coming to class at 10:30, the clock will keep running. And when you come back to the test, you won't have any time left.
Oh, wait, so how much time is given?
You've got 4 hours, but you
I-
got to use them in one shot.
I see.
You can go in and out. I want to be clear, like if you get kicked out of Wiley, you can go back in and it will let you back into the test, or it should let you back into the test unless you ran out of time. Because a few people contacted me in a previous semester and they're like, oh, Wiley doesn't want to let me back in and I haven't finished the test. And I realized that they couldn't get back in because they let the clock run out. So let's say you did an hour and the system kicks you out for some reason, you are allowed to go back in and finish the other 3 hours, but you cannot start tomorrow and think you're pausing the test and finish it on the 2nd. The time will be long spent.
I see. Thank you.
All right. Thank you for asking that. Although I've said it many times, I think the reality is that you have to try and make sure that you understand it for yourself. Okay, guys. So, we've got very little time left. So I'll just say these are the ending balances that go into the balance sheet. Now, remember, and maybe it's easier if I show it as part of the chapter 13. Well, actually, no, I'll show the solution, but I don't want you to freak out because on your solution or on your work, you're not going to have to put all this other stuff here because Wiley doesn't ask it of you, right? So what I do want to show, I'm trying to just like be, if you guys, you're not my age, so I was going to say I'm trying to be MacGyver, but I'm like, no one knows what that means. Anyway, so you're basically looking at a stockholders' equity. Do you see the 670,000 preferred stock? That's the number that I came up with right at the bottom over here. So that's where that ends up going. Then the common stock is the 470,000 that I also just calculated. The other numbers, this additional paid in capital and so on. If I had finished doing my ledger, I would have come up with those balances as well. The answer does show you how to do the ledger, but it does the 3-column ledger, which I know you guys also understand from accounting 1. And then the retained earnings does change. I just want to point that out quickly. Remember, we started with 300,000 of retained earnings, but we sent another 260,000 of retained earnings to the account. So that is why, for those faithful people who are going to look at this answer, that is why 560,000 comes up as retained earnings, because you're looking at the beginning balance plus, right, beginning balance plus the credit from the closing journal entry. All right. So again, all these things are here. You know, some of it might be a little bit wonky, you know, the way it renders because it's Word documents. Some of it may be overkill. It's showing a lot of extra information than needed. And I think just to be clear here, this answer is based on a previous version of the textbook where they didn't use stock dividends and cash dividends as the accounts that you debit when you declare dividends. So I'll have to go through and fix all of that. So in the meantime, if you see something that says debits retained earnings instead of cash or stock dividends, just remember that we use stock dividend, okay? Stock dividend and cash. I'll try and clean all of this up. I didn't realize that this was from a prior, the prior version of the book from some time back, and I thought it was up to date. So now that I'm looking at it with you, I realize that I need to go through and fix it. Okay, so what's the takeaway, right? The takeaway is not like, oh my word, my brain's going to explode. I'll never be able to pass this class or anything like that. Relax, okay? Just relax. You've got time to still figure this out. I'll do some more reviewing with you guys on Tuesday. What I do think is you owe yourself the time today to figure out a strategy of how you're going to study. Look at the test prep sheet to make sure you understand what's going to be asked. Work on the chapter 14 homework because it's 5% of your grade and it is due on Tuesday, right? So you want to make sure that that's part of your process. And then I think come in on Tuesday having questions for me if there are things that are confusing to you. I don't want to take more time here because I know that we're 1 minute over, but